Welcome to Chapter 13, Investing in Mutual Funds. Dear students, we have taken a look at bonds, we have looked at stocks, and we have found that in both cases it really isn't normal, it really isn't typical for us to actually go out and buy our own bonds and buy our own stocks. Some people will do it, some people will, and they may or may not find that they're very good at it. But when it comes to items that are not easy to produce on your own, we normally go out and purchase them from someone else whose expertise is building a car or flying an airplane across the country or making shoes. Or if we need insurance, we go to an insurance company. And in this case, we need investments. Let's go to an investment company because that's the legal term. You will not hear that term. You will hear mutual funds. But legally, they are investment companies. Another name that I hear sometimes is investments for the masses. I don't know where I saw it. Maybe I made it up. I'm not sure, but that's what they are, folks. For the vast majority of us, mutual funds make sense. One one complaint that people have about mutual funds is that they're boring. Well, that's true, but there's an industry saying that mutual funds will bore you to wealth. Assuming you forget about them, which is what we're going to find is what we really should be doing. So let's learn how to be bored to wealth. Slide number 2. What is a mutual fund? Well, very simply, it is a pool of money. It's an investment chosen by people who pool their money. And then the company, the mutual fund, buys the stocks, bonds, and other underlying investments the investment company is legally required to invest in because the company registered themselves as a regulated investment company, and there's an entire act of Congress that was done back in 1940 that outlined the mutual fund industry and has served the industry very, very well these many years. And what we get from mutual funds, I want you to memorize these two, folks, are professional money management. These people are supposed to know what they're doing. They get paid very well for doing it. Some are very good, some not so good. And we get instant diversification, something that it is very difficult for us as working grunts to get on our own. Every fund has a specific objective. It will be stock-oriented or bond-oriented or some other type of objective that is outlined in the prospectus and also in the accompanying sales literature because very few people actually read the prospectus. There are more than 11,000 funds to choose. 11,000 different funds. What's going on here? Do you have 11,000 different types of breakfast cereal in the grocery store? Well, it kind of seems like it, but no, it's nowhere near that. Are there 11,000 different types of cars on the road? Why are there 11,000 mutual funds? Well, we'll see. There's two things that have produced the number of mutual funds. One of them is plain and simple. It's not hard to start a mutual fund. You don't need a whole lot of them. You need more than, more money than most of you and I would ever have to start this business. But in the investment world, it's not a whole lot of money to get one started. And they are very profitable. They make a lot of money. Some don't, but most do. And what has happened is the world has just gotten so much more complicated that there are just dozens of different types of mutual funds, and companies compete. They all have to have one. If one has one, the other ones have to have it. So the competition has driven the explosion of mutual funds. And why are they so important to us? Well, because, as we'll see when we get to chapter 14, when we are planning for retirement, they simply make the most sense for the most number of people. Plus, they are what are offered to us, more often than not, in employer-sponsored plans, such as 401ks and 403bs and the like. Plus, they're also very useful in IRAs, traditional IRAs it's called now, and Roth IRAs. So we're going to see this as we move along. Here is my tried and true graphic that I produced myself. I want you all to be very proud of me. I know. I am not very artistically inclined, to say the least, but here you go, folks. We saw this before, didn't we? Here we are, the little people. And more of them are women, because women are deciding that they're not going to wait around for the guy, the man of the house, to take charge, because they saw what happened to their grandmother, their grandaunt. The goofball told her, "Don't worry, little lady, I'll take care of everything," and he sure did. Didn't save a dime, and then died and left her penniless. And so the younger women are going, no, not me. And we give our $50, $100 a month. If we can afford it more, congratulations. If not, that's good. As long as we're young enough, we have enough time, as we've seen and we shall see. And we give it to the people in the top hats. Those are the Wall Street. They're not all on Wall Street, by the way. They're not all in New York. The mutual fund managers. And luckily for us, more and more of them are women. Why do you say that, Payano? It's very simple. Women make better investors. It has already been shown statistically. It has been shown empirically, whatever word you want to use. Women make better investors. Why? Now, I'll leave it to you to come up with reasoning for why you believe women make better investors. But I believe it's just because they don't look at it as men often do. And we're talking in blatant generalities, folks. But men often look at investing like a sports game. They're going to throw the Hail Mary pass. They're going to swing for the fences. Well, you sports fans, what happens when you swing for the fences? You strike out an awful lot, right? And women, if we may continue to use the baseball analogy, they try to get singles and doubles. If it makes sense, great. And I don't even know if it's true, because no one has proven why. All they have done is proven that women are better investors. Cool. And what they do is they create a pool of money that, in my case, looks like a potato, but no, really is a pool. And that is called the mutual fund, the investment company. And then these mutual fund managers, they don't buy just 10 stocks. They buy 200. And if they buy stocks, it's called a stock mutual fund. And if they buy 200 bonds or 150 or more, it's called a bond mutual fund. And if they buy those short-term cash, should put quotes around that, cash. If they buy those short-term investments, it's called a money market mutual fund. But usually the mutual fund disappears and you just hear people call it a money market. So those are the big three. But there are dozens and dozens of combinations and permutations, and we begin to see the very first one called a balanced mutual fund, which invests both in stocks and bonds. And in our next presentation, we will spend the entire presentation just taking a look at the major categories, just some of the major categories of the types of stocks, because there are literally dozens and dozens and dozens of different types of mutual funds. Slide number 4. Why do investors purchase mutual funds? And so I want you to memorize the first two, folks. I want you to memorize the first two, because if somebody will ask you, well, remember, you're the expert for your friends and family. Why would I buy a mutual fund? Well, it's very simple. In just a few statements, you say, look, it allows for individuals who are, just working class, middle, just trying to get through the day. It allows us to benefit from professional money management and diversification. Now, The diversification part usually is never a problem because mutual funds normally own hundreds or more than hundreds of investments. So if one investment goes sour, the company is, for whatever reason, falls apart, then it doesn't destroy our whole portfolio. The fund manager, the professional management, this is the important aspect of our choice. Who do you want to manage your money? Well, you have to be careful because like professional athletes or celebrities, there's an awful lot of hype around some of these companies. And for me, that's dangerous. But then again, I don't really follow sports and I don't really follow celebrities, so I don't really appreciate that. But what we have found, now it's changing, but many mutual fund companies would shuffle their managers like a deck of cards and just go after the one who's hot. Well, that is anathema. I don't know how to say it, but that's not good, in my humble opinion, because it encourages the mutual fund managers to think short term, which is not good, folks. You want to think long term. So you have to look for an experienced management team, in my humble opinion. The third item is, you don't have to remember this, but I love it. This is from the wealthy barber, David Chilton, one of my favorite writers, who said the PETA factor is low. The PETA factor? What is that? Pain in the... You got it. It's a wonderful saying. And I think about it often, especially now after delving into the world of real estate. I have a renewed appreciation for the low PETA factor of mutual funds. Once you have chosen the mutual funds that you're interested in, you've seen companies with a good track record, there's not a whole lot you can do, folks. There's not much for you to do, except keep funding it, on a regular, consistent basis. Don't panic when the market falls, which it will do from time to time. Don't get greedy when the market zooms, which it'll do from time to time. Just remember that it is a marathon, not a sprint, if we were to use another sports analogy. Slide number 5, the growth of the mutual fund industry. Way back in 1940, there were 70 mutual funds. And yet, the industry still wasn't really recognized by many of the states and the federal government. I mean, these things had been around for about 15 years or so, but many of the regulators were taking a good hard look at it, and they didn't really like what they saw. They thought, what's going on here? I mean, you're investing for somebody else. Okay, we understand that. But there's tremendous opportunity for malfeasance, fiduciary irregularities, hanky-panky. Yeah, they were worried. You're holding on to somebody else's money. Are you being regulated like a bank or an insurance company? Well, they weren't. Every state had their own rules, and some states didn't like these things at all, and the federal government didn't really know what to do with them. Plus, the IRS was saying, wait a minute, you guys are making money. You owe us taxes. And the mutual fund companies say, no, you don't understand. We're making money for our shareholders. Tax them. Oh, okay. Well, in 1940, the Republicans and demagogues got together and played nice with one another in the sandbox and came up with the Investment Company Act of 1940. So I tell you this because it can be done, folks. The two parties can get together and do things for the good of the country, and it has stood the test of time. It created what are called regulated investment companies, of which mutual funds are just one type, but they're the biggest type by far. There are a few other types, but they're very, very small. And these are pass-through investments, which means the mutual fund is making money, is investing and doing well, or maybe not so well, for their shareholders, but the taxes are paid by the shareholders, because the mutual fund then passes through the earnings and the capital gains and the dividends and the interest to the shareholders. Does that make sense? Yeah, it does. And it was a wonderful piece of legislation. They've tweaked it a couple times, but for the most part it has stood the test of time, which shows you that we can have a Congress that works together, folks. I just wanted to let you know that. And so in 1940 there were 70 of these mutual funds. 1970 there were 350, which is, pretty decent growth. By 1980 there were 600, and then in the 1980s and 1990s you see explosion. Exactly. Why? Well, we'll see why in our next presentation, because they started coming up with all these different exotic blends of mutual funds, and then if one company had them, then all the other companies had to make one too. To the point now where by the end of 2016, there were 11,836 of these things. Almost 12,000 mutual funds. Wow, wait a minute. That doesn't make any sense. I mean, are there 12,000 different breakfast cereals in the aisles of the grocery store? Well, it seems that. No, they're not that many. Are there 12,000 different types of cars? I don't understand. Well, as I just mentioned, the industry started to balkanize and chop up their offerings into little bitty pieces, and the permutations and the combinations just exploded. And that's what makes mutual fund investing hard. We said the beta factor is low, yes, once you own the mutual fund, but choosing a mutual fund is a daunting task. And again, we'll get around to that. Relax. Towards the end, we'll show you some we'll show you one individual mutual fund, but then we'll show you some others that have done well, have stood the test of time, done well over decades, and hopefully that will help you. But I'm not going to sweet coat it, folks. Sweet coat it, yeah. Sugar coat it. It ain't easy. It's not easy to pick a mutual fund or mutual fund company. There are some that I really like, and if you ask me, I'll tell you which ones are my favorites. But that doesn't mean they're the best for you. Plus, there are many other very good choices. So you get down to the point where you think, well, hey, wait a minute. He likes that company. Well, how about she likes this company? They're both good companies, folks. There are some not so good companies, and I'll be sure to tell you what I think are not so good companies if you ask me. But I'm not going to put it down in here. Yeah, this is what you're up against, okay? But, folks, the mutual fund industry ain't perfect. Nothing is. But it is now the nation's largest financial intermediary. What does that mean? That means they hold on to more money than the banks. They all hold on to more money than insurance companies. Yes. And people depend upon mutual funds for their financial goals. It sounds like an advertisement. My apologies. But it is. Nothing's perfect, but the mutual fund industry has done well for its investors over decades. And some have not done so well, but that's why you have to do your due diligence, or consult a financial advisor for whom you have the ultimate trust. Sounds like another ad. Let's come on. How do I get going? Let's go to the next slide. Slide number 6. How do you conduct transactions? Well, purchasing mutual funds originally was done through a broker. But then the investment companies said, hey, go through us. Bypass the broker. So you can do either. You can go through a brokerage account. You can have an online brokerage account and never talk to a broker and buy them. Or you can go directly to the investment company. Again, you could do it online, never talk to somebody. They have representatives. Now, they don't want to give you investment advice. You understand? If you ask for investment advice, they're going to say, well, you have to talk to one of our licensed brokers. And some of them just don't offer it. They might say, well, you need to find a broker who can give you investment advice because we don't do it. And others will. Some of them have their sister, Vanguard and Fidelity, both have a brokerage firm that is not the same as the mutual fund company. It's a sister company, but they'll refer you to them and then, expect to pay for that advice. The best way, in my humble opinion, is through automatic contributions. You dollar cost average. Remember that word? Remember that phrase? $50, $100 a month, more when you can afford it, through your payroll, through your checking account. And then you just set it on autopilot and let it go. And you're not saying you're not going to review them. Yes, you review them every 6 months to a year, but no, that's it. That's why people call them boring. What about the sell options? How do you sell when you need the money? Where do you go? Well, again, call your broker, go online, go call the mutual fund company, go online. And the best way, in my humble opinion, again, is through automatic withdrawals into your checking account. Set it up so that it happens automatically. So here's the deal. You ready? You ready? Listen carefully. You automatically invest $50 or $100 per month for 30 years, 40 years. Some of you millennials, 50, because you're going to be working into your 70s. And then you automatically withdraw $2,000, $3,000, or more per month for the rest of your life. Are you interested? Sound interesting? Are you excited? I think you should be. Oh, wait a minute. Let's read the small print. Did I mention there are no guarantees? Exactly. Are mutual funds insured by the FDIC? No, indeed. You can, and there are times when you're going to lose money, especially if you want decent returns. But what we're going to see is that if you are prudent, if you think long term, ignore the volatility, the times when the market crashes and everybody says run for the hills, and the world doesn't end. Remember, the world, that's another part. It really does have to stay together, this technologically based civilization. Then we should do okay. We should. No guarantees. But, as long as the world doesn't end, I'm confident that if you invest prudently, consistently, long term, you should do well. I'm trying, so far so good. Slide number 7. Uh-oh. Well, yeah, you got to talk about it, folks. You got to talk about fees. Is the mutual fund industry a non-profit organization? No, they are a for-profit organization, or organizations, for-profit entities. So you're being charged. Now, here is an example of where people know they're being charged. They know, come on, you're not doing it for free, but they really don't understand. And part of that is because of the prospectus that is given to them, which they don't understand how to read. And another part of it is that they really don't want to know. Sometimes you get this feeling they really don't want to know. So I do my best to explain it to people. And in the 121 class, we would have an entire chunk, a big chunk of this presentation would be dedicated to fees and discussing fees. And I'm not quite sure if I've totally given up, but the questions that I would then ask on the exam would demonstrate to me that people did not understand a single word that I said. They were all very polite, but then I would go, okay, I'm not getting through here, so maybe we should just cut it back and leave it at a couple of slides. So I apologize, but that's what I'm doing this, and we'll see. I'll practice. Maybe I'll make an optional. That's an idea. I'll make an optional presentation that just shows you the different fees and the different. Let me write that down so I won't forget it. I'm just thinking out loud here. My apologies. Okay, so how are you being charged? Well, all mutual funds, all investments, by the way, have annual operating expenses. They are charging you yearly based on a percentage of the fund's asset value. Well, if a mutual fund is run correctly, it is not an inexpensive enterprise. It costs money to go all around the world because companies are global now, and do the research necessary to make informed, prudent, I keep using that word, but I'm serious about that. It's easy to go out and buy the next Netflix and Apple and these companies that are exploding on the upside, Facebook and Twitter, without doing the necessary research needed to know whether or not it's a decent long-term investment. But there are thousands of companies, folks, thousands, and how would you know which ones are the best investments other than hearing what you hear on the news or radio? No, it's an expensive proposition. And so what they do is they charge you anywhere between 0.5% to 2% of the value of your investment. Now, what does that mean? Well, say you have $100 in there. 0.5% translates into 50 cents. Some charge 2% or more, which I think is way too high, personally, which is $2 for every $100 you have in the account. And they do that in perpetuity, which means every year. Some, though, have extremely low fees, such as index funds and exchange-traded funds. And we'll have a couple of slides on those in the next presentation because their popularity is increasing greatly. And there are reasons why, but they're not perfect. No investment is. And I think right now the explosion of index funds and ETFs is ignoring the people who are involved in that. They're ignoring the downsides of these, and which is typical in the investment world. Some mutual funds have a commission that is associated with the fund. Sales load is what it's called, a sales commission, a sales charge. And this was the only way to buy mutual funds many years ago because they were only sold through brokers. It was originally used to compensate the financial representative who sold the fund to the investor. But that whole world has changed in many ways, which we'll hint at on the next slide. And in the chunk I described that I talked to you about, we went into great detail. But not all funds charge a commission. Many are what we call no-load. Those are funds that do not charge a commission. So you have load funds and no-load funds. But you have to be careful because some no-load funds do have low annual operating expenses, but some have very high fees and high annual operating expenses. So a load fund that charges a commission can wind up costing you less than a fund that doesn't charge a commission because you wind up spending more over time. That's all in the prospectus, which you didn't read. Slide number 8. We will spend just one slide doing what we used to spend, 12 or 13 slides or more. I forget how many, but I think it was about 13 or 14 slides, where we would go through these fees in detail. And it wasn't working. So let's just spend one slide on it. Traditionally, the only type of mutual funds were load funds. They charged a front-end load. They were called Class A shares. They had lower annual operating expenses, an upfront fee. But people didn't like paying that upfront fee, and the industry does its best to make it easy for you to part with your money. And so they created back-end fees, Class B. By the way, some people call them Class 1 and Class 2, but most of the time they're called Class A and Class B, which have a back-end fee, but then they have higher annual operating expenses. And people would say, well, what difference does it make whether I have a front end or a back end? You're still going to charge me. No problem. Sit down, relax. The back end fee is a contingent deferred sales charge. Don't you just love that? I love that name, contingent deferred sales charge. It means that the first year will be 5% if you take it out. then 4 the next year, and then 3, 2, 1, until finally, after 5, 6 years, 4 years, everyone has a different schedule, but after a certain amount of time, you don't pay any sales charge when you pull the money out. But they're getting you through higher annual operating expenses. So you wind up, in many cases, not if you have the money in there a long time, you wind up spending more with the Class B shares. Then the brokers used to love these Class C shares because they called them no-load broker funds. That's what they called them. There was no upfront fee, there was no back-end fee, but they had higher annual fees in perpetuity, which is a fancy way of spitting on your friend while you say forever. Or maybe I've seen some 10 years. For 10 years, they have higher annual fees. Well, the Securities and Exchange Commission said, oh, look, you're just taking the sales charge and you're spreading it out over 10 years. So we're not going to allow you to call them no-load funds. They must be called load funds where the load is amortized, which is a fancy way of saying spread out over a certain number of years. All right, well, the broker said, all right, we'll take care of you. They then created the advisor no-load fees. Securities and Exchange Commission? No upfront fee, no back-end fee, no higher fees every year for 10 years or so. But we're going to earn up to 1 or 2% every year. What? What did you say, Mr. Advisor, Miss Advisor? We're going to charge an extra 1 to 2% every year to manage the account. These are the Class F shares, the Class I shares, or FI, sometimes Financial Investment Advisor, Financial Advisor. This is the modern day go way to to charge your clients. And I don't like it. Remember, I'm a broker. I don't have any clients that do this. They wind up spending more if they are long-term oriented than if they simply paid the upfront fee and got the lower annual operating expenses. But brokerage firms, brokers are moving to this model en masse. Why? It's got, in their humble opinion, it's got two great things. You're not charging them a load, so you can tell them, hey, we're not charging you a load. We're not charging you a sales commission. Plus, they make more money over the long term, which is great for them. I don't think it's very good for the clients, and I will do my best to explain that to the clients. And as with the friend of mine who's an insurance agent who said it's kind of like cigarettes, they're going to hurt you, but if you want me to sell them to you, I will. I don't know that I would, because once I explain it to potential clients, they either say, well, I think you're right, Payano, and I'll go with you, or they say, no, I'm going to do it anyway. I say, fine, that's your decision. The last category, or what we put in quotes, are what the financial media calls true no-load funds. Now, there's no legal definition for that. There's no legal definition for true no-load funds, but that's what the financial media will call them, true no-load funds. They may not have a 12B1 fee greater than 0.25%. Forget about it. The 12B1 fees are those fees that allow the mutual funds to amortize, to spread out the sales commission over 6, 8, 10 years. And so the Securities and Exchange Commission said, look, these 12B1 fees, and again, that's a section of some code somewhere, so it doesn't mean anything to anybody other than people who know what it is. And they said, look, all you're doing is you're taking the upfront sales charge and spreading it out. So you cannot have a 12B1 fee that's greater than 0.25% to spread out the load. All right. But, as we said on the previous slide, that doesn't mean that the overall fees are low. Because over time, a no-load fund can wind up costing you more in fees than a load fund. You must look at the annual operating expenses and determine whether or not you believe they are in your best interest. Are you getting a good value out of your mutual fund? It's not an easy determination to make. Okay, so make sure you understand what's in this presentation, these first 8 slides. In our next presentation, I want you to Be ready, because it's like a sip from the fire hose, folks. We're going to go through the spectrum of risk versus return of mutual funds and find that it is very difficult to get your arms around the industry and choose a mutual fund, let alone a mutual fund category. Choosing a mutual fund within the category is even harder. So you ready? It's not impossible, don't worry, but it is uncomfortable for many people, and I hope to show you that people deal with it and are successful. So we'll see you in our next presentation when we go through the full spectrum of the different types of mutual funds.